Good evening, everyone. I hope all of you are keeping safe and doing good in terms of your studies. I'm sure the momentum is being carried on week after week as we move in closer for yet another examination. And I'm to yet another series of lectures on this important topic. I'm Chartered Accountant Manubhav Verma. As we did a couple of sessions or couple of topics together earlier, cost of capital, investment decisions. I will be your chauffeur for working capital related modules as well. So I'm sure each one is doing good here. I could already see a lot of activity on the Q&A or the query panel. So it's guys. So today we'll be focusing on the working capital management, and I'm sure that we talk about working capital. Everyone understands that it's a very important short-term source of finance for every organization, and I'm sure each one knows what is working capital, right? Let's see if you guys can. So I'm already getting replies. I think everyone is on the same page with respect to understanding that it's short-term obligations. Yes, we are talking about current assets minus current liabilities. Great. So I think, yes, so we all agree that working capital is important. It is a very important short-term source of finance, but yes, that it is basically the net current assets, or we can call it as a different way of explaining working capital could be a gross working capital or a net working capital. Gross working capital reflects current assets, but when we talk about the working capital or net working capital, it's your current assets minus current liabilities. But yes, it's an important source of a short-term finance for day-to-day operations. Now, we all understand that, yes, what are the current assets? The assets that are expected to be used within the 1 year or operating cycle, whichever is longer. And the examples, we have your stock, inventory, your receivables, cash and cash equivalents, prepaid expenses. However, when the same definition talks about the current liabilities, although we all agree that, yes, these are the liabilities which will be expected to be settled in a normal operating cycle or 1 year, whichever is longer. But in addition to that, these liabilities are supposed to be either settled by creation of another current liability or by using current assets. What I mean to say here is that, let's say there is a current liability or a short-term note payable, which is due on 15th of January. Okay, I'm coming with the question from Gomati. Gomati, right now I cannot go back to investment decisions. I think probably you can send in your query. We'll revert it. Right now I cannot open investment decisions. I want to focus on working capital, please. Okay. And I think we had solutions already in that file, which was uploaded a couple of days later. So maybe you can refer that. Okay. So yeah, I was talking about the current liabilities and I was giving an example. So the example I have here is with respect to a short-term note payable, which was payable on 15th of January. Now, what this company did was they took a 5-year loan to repay that 15th January, or rather, if we talk about 1st April to 31st March as a financial year. So we talk about 15th April, let's suppose. So there is a short-term note payable which is due on 15th April. I mean to say next financial year. And you're talking about taking a long-term loan to pay that. Guys, what do you think? Should that short-term note payable be classified as a current liability or not? What is your opinion? That short-term note payable, which was due after 15 days of the balance sheet date, and you guys, the company, took a 5-year loan to repay it. So when they repaid that, how or what would be the impact on the classification of that particular note payable? Any suggestions, guys? I can see a lot of responses from coming in students, but Siddharth says it will still be current liability. Wow. Anyone else? Hiral, Rahul, Hitesh, What are your thoughts? If you guys want to understand that, okay, this is my financial year, 1st April, 31st March. So there is a short-term note payable here, which is actually on 15th April paid off by taking a 5-year loan. My question is, if I look at the definition from a perspective of, are we using a current asset or are we creating a new current liability? I probably feel that we are paying this off by raising another non-current liability, guys. Do you agree with me? We are paying this off by taking another non-current liability. And probably there can be a requirement in that case, whether in the 31st March balance sheet, should we classify that note payable as a current or non-current? Because the intent has been clearly shown that company wants to pay that with a non-current liability here. And that is why this is very important for us to understand the exact classification. Although more of an accounting thing, but I wanted you to understand the concept of current liability. So guys, as I said, the working capital, you have to be careful. Are they asking you the gross working capital or they're asking you the net working capital? Of course, we discussed in the investment decisions, capital budgeting, that there could be a permanent working capital initially. There could be a temporary also. We remember in the capital budgeting, we discussed a lot of working capital, 3 possible scenarios, increase in working capital in initial years and probably at the end of the project, the working capital was released and so on. So that was a discussion in investment decisions. Having said that, when we become a little bit of a nostalgic thinking of our school days, I remember we were taught that there has to be an ideal current ratio, which is current assets upon current liabilities, a kind of a 2:1. Or when we talk about a quick ratio, that is, liquid assets upon current liabilities of 1. What I need to explain you guys is this a standard defined current ratio pan industry? Can we say that 2:1 can be a standard current ratio, or in terms of the working capital requirements, equivalent for all the companies, guys? Or let me ask you a different question. Think about wherever you are living. Think about your nearby markets. Can you give me examples of two successful outlets or shops, one of which is loaded with inventory and working capital, and one of which is actually doesn't require much working capital to operate, but both of them are equally successful? There are a lot of people, a lot of crowd over there. Can anyone give me 2 examples? So we're talking about versatility in terms of the requirements of working capital. Siddharth says it's just an optimum level. It may change according to the real life situations. Absolutely correct, Siddharth. So what about the situation I was asking? Can you give me examples of 2 particular outlets? 2 shops nearby wherever you are living? Bandredi says dress shops. Okay. Anyone else? So guys, my question is, think of 2 shops which are equally successful. There are always people over there doing some shopping, purchasing. There is a crowd. One of them is requiring a huge working capital, huge inventory. Other actually doesn't require any working capital or very negligible working capital. Hiral has a very, very interesting suggestion. Hiral says, we're talking about the supermarket and the milk mother dairy. Amazing. Even Smitha comes up with an example of D-Mart, that is your supermart with more inventory. And Pooja says Big Bazaar has huge inventory. Yes. So I think you guys are absolutely amazing. Bandredi has a very interesting example of a lens cart having less inventory. So I think pretty much you guys are all on the same page that we all agree to the fact that yes, we are talking about that there are certain businesses which may require a huge working capital, huge investment in inventory, supermarts, pharmacy, bookstores, but something like perishable industry, right? The example was given by the milk one, right? The Hiril gave that example. Or you could think of a restaurant. You could think of Domino's. Do they have a huge inventory? They cannot afford to, right? It's a perishable items. So, but they are definitely. So Pooja said about the vegetable and fruit shop. So absolutely correct, guys. So good job. I think you guys are absolutely on the same page when it talks about the adequate level of working capital. But don't worry, we'll talk about other factors as well. Now, the key part here is neither you want excessive working capital, nor you are in a position to accept a shortfall as well. Because if you carry over investment, you may enter into some kind of an opportunity cost or even loss of inventory, because you would have invested that extra amount somewhere else. Why to block in working capital? And if you are not having enough working capital, then probably you may not be able to pay your short-term obligations. If inventory is not there, customers may not come to you again and again. So all of these are challenges. So basically throughout the chapter, we'll be talking about the right balance, how to create a right balance in terms of ensuring adequate levels of different components of working capital. As you can see, this is a self-explanatory slide, which is like how the working capital requirements can be in the business. Now, on the left-hand side, we are talking about a business where there are peak season, there is a off season. In the peak season, your working capital requirements kind of increase. You know, something like in India, we're talking about Diwali or festive season coming in. And on the right-hand side, we are talking about a situation where the company is also growing in terms of, let's say, number of stores and so on. So not only your peak seasonal demands can be increased, but I think very importantly that your permanent working capital increasing means that companies is kind of on the way of expansion. So I'm sure this much is pretty much clear. Now, in terms of significance, yes, we talk about this already. It's of course, it's not only the short-term liquidity or short-term source of finance, but it is also very important that in terms of the reputation and overall requirements of the business as such, your working capital requirements have to be consistently met to ensure the survival of business in the long term. And we already discussed this, right? Investment decisions, capital budgeting. We talk about that already. Now, we need to understand that yes, there could be in a situation that if you are coming up with let's say a kind of a ad hoc order or some kind of a new project, that means in that case there would be a requirement of enhanced inventory levels, probably enhanced liquidity. So you never know what comes up. So we need to understand that there could be situations where you need to have an increased production levels, but we also need to understand that when you are increasing the sales, okay, you want to go for profitability, what you can end up at is also probably having a little bit of a relief to the customers. What we'll talk about here is how an organization will balance two scenarios, that is a liquidity and profitability in terms of the working capital management. So we'll talk about this, but first of all, I would like to focus on what are the other factors that could determine the working capital requirements. As I already told you, the first one, nature of business, right? We talk about the restaurant versus pharmacy. It could be type of products, durable versus perishable, operating efficiency. So let's say, I guess you guys know that, let's say some organizations who are following EOQ or just in time, if there are so many advanced tools they're using, probably the working capital requirement may be less. So if there are operating efficiencies, then definitely the working capital requirements could be less here. And for that, we will be talking about those, inventory techniques, receivable policy, credit period. So all this will be discussed in the receivables management. Price level changes, of course, in terms of the inflation and interest rates. Short-term financing options. Now, what are the options available in terms of the financing of the working capital? Market conditions, company policies, and so on. All these factors will actually determine how much should be the optimum working capital that could be required. But the problem is that there could be danger on either side. And when I say danger, I'm talking about on one side, you're talking about a higher working capital. On the other side, you're talking about deficiency or deficient working capital. Higher working capital, more funds blocked, opportunity cost could be there. Lesser working capital, maybe enhanced liquidity, but probably you may end up losing some sales. So let's discuss this, guys. How organization can balance this out? So when we talk about working capital management, we always talk about 3 E's here. Economy, because see, everything comes at a cost. Who knows better than you? You guys discuss with me cost of capital, right? So we would have arranged some finance from different sources. So economy and financing, you would definitely want to achieve a minimum cost in that regard. In terms of the efficiency, it is very important, since we are talking about the limited resources, we need to utilize them to the utmost potential, and of course effectiveness in achieving the intended objectives. So guys, always remember, economy, generally it relates to the cost and the time probably, and efficiency actually drills down from that itself. So because efficiency is, how you achieve a target, but the effectiveness is related to the objective, whether you are achieving the intended objectives or not. But now, if I talk about that, there are two extremes, right? We're talking about a seesaw. If you're talking about more profitability, your liquidity could be less. If you talk about more liquidity, your profitability could be less, because I hope each one of you agree with me that profitability and liquidity are different horizons. Now, in terms of the working capital, how can we create a balance? That's what it is important. We need to arrive to a trade-off here. So let's discuss this one by one to each component here. Let's take an example of inventory here. So guys, let me tell you what will happen. Okay, let me ask this question to you guys. What will happen if you are keeping additional inventory in your business? What will be the positive part? If you're having enough variety, additional inventory, what will be the positive part? Who will tell me? Rahul, why not? Why not? We are talking about good discussions across 3 days, and I'm sure there has to be some efforts putting in from your side, right? You'll be doing some practice parallelly. Okay. Karthik says ready for sudden demand. Devanshu says no stock out. Absolutely. So guys, basically we are talking about, okay, Siddharth says we don't need to order again and again. Very good. So basically what we're talking about is we're talking about fear stockouts, right? As in that you'll always have varieties, options for the customers. So if you're talking about good inventory levels, can we say that probably we will be boosting the sales, and hence we are talking about profitability here? But the problem is there could be, on the other hand, if we talk about of a lower level of inventory, lower level, we say that, okay, it requires less capital, but the problem there is that it could be a stock out and less loss of stock or reputation here. Whereas in terms of a higher inventory level, what are the minus points here? The minus point could be your perishability, opportunity cost. Am I correct, guys? So plus and minuses are there of the extremes, what we are discussing. But what we need to arrive at is a good trade-off here. Siddhant says we can accept certain huge orders. Sudhanshu says we can meet additional demand. Good. Hero says quick selling. Vandati says can match excess demand. Pooja says we may run out of stock. More ordering costs is what Siddharth said. And Smita says funds are blocked. Loss of opportunity. Yes. So absolutely, guys. This is what we are discussing here. If you talk about higher level of inventory, you are blocking the funds in the stock here. But on the other hand, if you're talking about lower level, although there could be a benefit that you're talking about process efficiencies, less capital, but there's a huge risk. You may run out of the stocks, right? But what is the trade-off for inventory? We'll talk about this. I'm sure you guys have studied in your other curriculums that about something like economic order quantity, something like just in time. We'll anyways discuss them in brief. Now, receivables, guys. Think about receivables. Okay, let's see what will be the result of a relaxed credit period, guys. What will be the result of a relaxed credit period? So let's see your responses. If I want to give more number of days for the customers to pay me, what if I give more number of days to the customers? What do you think, guys? Vandriti says increase in working capital. That's okay. So your receivables. So I think you need to understand one more point is I think the immediate impact will be that customers will be attracted to you. Gomati says the revenue will be increased. Siddharth says people will be happy with our attitude. Siddhant says attract more customers. So basically all of us are agreeing that sales will be high. So that's a good part. Profitability will increase. But the problem is that there could be bad debts also. There could be a negative aspect, bad debts. Because longer collection period. Now, on the other hand, if we're talking about less credit period, that means we are concentrating on more cash sales. That means we are focusing on liquidity. That's okay. But the problem is that it can discourage the customers. Customers may have better options in the market. And in this case, okay, Karthik says positive effect. Sales might increase if you're talking about a higher level. Hero says increase in insolvency of debtors. Okay. Yeah. So here that is basically a negative impact, right? Great, guys. Good. Everyone, awesome replies. So first half an hour itself, I can see that excitement building up onto this important module. Now, how do we get a trade-off between profitability and liquidity? I think the best part is probably study about the receivables, study about your customers, evaluate the credit policy. Probably you have to see the background or to give the due diligence, have a credit check. And also probably you can use other services to expedite the collection, which is like factoring or pledging. We'll talk about that later. Similarly, if I talk about cash and cash equivalents, if I'm having a higher level of cash and cash equivalents, that means I'm able to pay my debts on time, guys. More cash, more liquidity, I can pay my debts on time. And hence my reputation will go up, goodwill will go up. But if I talk about lower level, then the problem is, again, the problem is that you may not be able to pay those in time. However, the advantage is since you're talking about a lower level, that means you could have invested, you could keep your funds invested in marketable securities or other venues if you want to have a lower level of liquidity. Prepayments. I think prepayments are pretty much basic because you have already paid in the past. So of course, a higher level of prepayments means that if the prices of the particular service or commodity increased, then you do not have to pay that at an increased price. So it's like good profit in terms of inflation. And of course, if you talk about lower level, that means good for your liquidity. You can keep a higher cash, right? In terms of payables, though, the last point. Siddharth says we can also study the customer's income. Smita says inefficient investment leads to loss of opportunity cost. Absolutely good, Smita. Smita says, so basically, if you're talking about like incorrect investment options, then definitely it's also tantamount to opportunity cost. And Siddharth said that, yes, we can study the customer's income and so on. I think that is also good. It's part of the due diligence factor, which I was mentioning, Siddharth. Yeah. So in terms of the payables, guys, higher levels of payable, probably positive part is that, okay, you are able to withhold some payments. You may be able to invest that money, but the problem is that what if you're missing the deadlines? You don't want to miss on the deadlines. You don't want to lose on the credit rate. If your reputation goes for a toss, who will be your supplier? That's very important. And in terms of the lower level, of course, that will be definitely boosting your revenue or in terms of your reputation, because you will be having a good reputation and you'll be having more connects in terms of vendors. You have been paying them on time and so on. Again, here also, just like your receivables, you have to evaluate your credit policy for the pros and cons to arrive at a trade-off between profitability and liquidity. Siddharth says, can you please explain the cash again? Okay. Siddharth, what happens in the cash? If you give higher level of cash, that means you can pay your debts, your obligations in time. That part is clear. And when you're talking about keeping a lower level of cash, that means you do not need cash. Probably what we are doing is, even if we have a surplus cash, we can keep them invested in any kind of avenues, marketable securities and so on, because we don't need a higher level of cash. That's it. So that could be in terms of liquidity, that's a benefit out of the liquidity. So if you have a cash in hand, probably you can invest in other avenues. Smita says prepayments. Smita, what happened? Prepayments, if I have prepaid an expense already, do you agree with me that if the expense or the service charges of that particular service increase in the future, I've already paid for it, right? Will that increased rate affecting me? No, that's a positive part of it. But when it comes to the negative, like if you're keeping a prepayments to a lower level, what we are looking at is a liquidity part. That means we are probably not interested in making too many prepayments, and I want to retain my cash for other investments. Smita, I hope it is fine. Siddharth, thanks for the confirmation. Any other student guys, anyone else want to ask anything on this? Okay. Now, this is a very, very important slide. Why I say so is we are talking about various types of working capital policies or approaches the organizations can keep. So what does this mean? We are talking about, okay, it's an organization choice, how much they want to invest in the working capital. Probably I would say that depends on the requirement of the organization, the factors we discussed, the nature of the business, type of the product. But don't you think it can also depend on the risk appetite? What kind of approach the organization does always follow? So that means what we are looking at is 3 different types of policies. Organization can believe in aggressive attitude towards the working capital management. Okay, Hitesh, I'm just having a couple of questions, guys. So let me read out those questions. So Hitesh is asking, there can be a chance that in future the expenses fluctuating in nature. So is there a disadvantage of prepayment? Hitesh, more or less the chances of inflation is more likely than prices going down, right? I do not deny your statement 100%, but I'm saying that in all probabilities, price increase is more of a chance. Pooja says a high opportunity cost in prepaid expense. Pooja, that's fine. So high, if you keep a higher prepaid expense, there are plus and minuses both. Hitesh, to your point also, if the prices go down, then it's a minus point, right? They're both the plus and minus points. At the end of the day, we are arriving at a trade-off between profitability and liquidity, guys. That's the point. So we need to keep a balanced, like not too high, not too low balance. That's what the objective is. Everyone okay, guys? Sound good? Okay. So now coming to back to the working capital policies. So aggressive policy, guys. So aggressive means that you are very good in risk taking. You enjoy more risk. So that means we are okay to keep a very negligible working capital. Probably we believe in our controls and our systems and our processes so much, that we are pretty confident that organizations can manage with a lesser working capital. And that's why we are talking about aggressive here. Right? So that means we're talking about like low working capital, aggressive. That means probably less inventory or stricter credit terms or less receivables and so on. So lower current assets upon fixed assets ratio, because we are talking about a lesser working capital. Positive part, yes, you do not have that much funds blocked, But the negative part is that what about your growth? What about your growth? It's again the profitability versus liquidity question. Conservative, the other extreme. Conservative is that you cannot take risk. You don't want to take a chance. Who knows that customer asks for this product as well? Who knows the customer asks for that particular textbook also? You want to keep everything in a bookstore. Or you are pretty much scared that okay, customer may go to the competition if you don't give them enough credit period. So let's enhance the credit period. So you are pretty conservative in nature, and hence when we're talking about conservatism, we're talking about keeping a higher level of working capital. I think most of you are also applying this concept of conservatism in terms of working capital management in your day-to-day life. Forget about the organizations. I'm sure many of you in your wallet or in your bag, you keep your funds, or these days it's a plastic money or people use cards. But when it comes to cash, people tend to keep a little bit of extra cash. Am I correct? For a rainy day, for a sudden expense, people tend to carry a little bit of an extra cash. That's certainly the case, and that's being conservative, right? So you want a higher working capital here. So probably you're interested in high inventory levels, and hence your current asset upon fixed asset ratio will be high. Guys, why? If I'm talking about my balance sheet here, so higher working capital would definitely be talking about higher current assets, and hence if I talk about current assets upon fixed assets, the ratio will be higher in terms of conservative. Now, what's the positive part? Yes, Siddharth. So I think everyone does. Not only you, everyone does. So the positive part is of conservative is yes, that you will always have that cushion available for additional customers, for new projects. So growth in sales, profitability. But the problem with the negative part is that it could be like higher receivables. It could be risk of bad debts. It could be opportunity loss because you're getting your funds blocked here. So that means midway approach is a moderate policy. And when we say moderate policies, guys, some organizations would like to balance the risk and return by the funds and probably keep a balanced working capital for each component. Great. Now we talk about a good reflection of these three policies in terms of a graphical way. You can very well see here that what's happening in this case is the conservative policy is kind of having the highest level of the working capital. And in terms of the aggressive, look at this. A good way to look at it, right? So you have anyways till this level, you have your fixed assets. So the aggressive only this much working capital, average is like this much, and conservative is the maximum of all. So that's more from a working capital management perspective. But what I was talking about is a ratio, current assets to fixed asset ratio. This definitely reflects the policy, which I already mentioned, guys. So what is a higher ratio means? Higher working capital, that means conservative. Lower ratio means lower working capital, that means aggressive. Guys, I hope you will be able to recollect this. You will be able to recollect this. Don't try to ratify, try to understand. Okay, we're talking about like conservative, high working capital. Aggressive, take risk. You don't need to have any questions. Aggressive means no questions, right? So take an example here. We have an EBIT, three different levels having the same EBIT. But what changes is current level, current assets level. My total assets are 10 lakhs, 9 lakhs, and 8 lakhs. But the proportion of current assets is kind of highest to the lowest from left to right. So if you see return on total assets, my return on total assets is kind of increasing. But when we're looking at current assets upon fixed assets, we are looking at that as a decrease. So can we say that probably this has an inverse relationship? And can we say the profitability and liquidity is now justified? What do you think, guys? What do you think? So we are talking about a less working capital. Return on assets is of course more, but the ratio of current assets upon fixed assets is less. Guys, everyone okay here? Smita says explain aggressive policy. Smita, aggressive policy is what it means that you can take some risk, right? When we're talking about aggressive policy, what we are looking at is that you want to keep a lower working capital. That means you are so confident on your systems. Let's say you're talking about just-in-time inventory levels. You're so confident about customers that as and when you need funds, you will get the money and you will pay back. So the idea is that you are okay with keeping less working capital. You're aggressive in nature. You're okay with carrying less cushion. Everyone okay, guys? Smita, is this clear? So what we are trying to prove here is that, of course, that yes, as we are talking about requirements of increasing the current assets, what is eventually gone is that there is definitely not an equivalent level of return on total assets in terms of the efficiency. And very logical also, right? So same level of profits, you are just keeping on adding the assets. If I look at from right to left, right? From right to left, same level of EBIT, and you're just keeping on adding assets. Of course, your return on total assets will go down. Very, very important section now. I want everyone to please concentrate. We are talking about heading towards a little bit of a practical aspect of working capital in terms of the first we talk about working capital cycle, then we will be moving towards calculation of the working capital itself. So we know in terms of number of days, working capital cycle indicates length of time between companies paying for materials, entering into stock, and receiving the cash from sales. Let me do it in a layman language. Guys, if you talk about from a business, one operating cycle starts from purchasing of raw material. You purchase the raw material. You will do the production, convert them into finished goods. Then probably during, like you may take some time to materialize your sales. You then also talk about collections. So can we say this entire period is definitely worth considering the entire operating cycle? Is everyone with me on this? This is what we understand from an operating cycle. From the point of purchasing raw material till the point of collecting our cash from customers. The idea is, don't you think during that period you also enjoyed a benefit? Let's say this entire process took 45 days, but your vendors gave you 15 days to make the payment. Don't you think you enjoyed some benefits also? On one hand, you took some time to make it happen and to realize, to complete your operating cycle, but on the other hand, you were also given some time by your vendors. In that case, we should subtract the time given by the creditors to arrive at our net operating cycle. How many of you agree with that? From the entire working capital or operating cycle, from the raw material stage to production to sales to collection, we'll add all those and we will subtract the time period given by the creditors. Is everyone agreeing with that? Because that's the period you enjoyed also, right? You did not pay them on time. So you can see the flowchart here, moving from your raw materials, labor, overhead, WIP, stock, receivables, and again you enter the cash and expand the business. This is what we are doing. Okay. Now, one question for everyone. What do you think, guys? Are we looking at a longer operating cycle or a shorter operating cycle from the organization perspective? As an organization, what would you prefer? A longer operating cycle or a shorter operating cycle, guys? Pooja has a very interesting statement. Time we get, time we give. So time we get minus time we give. That's an operating cycle. Good way to look at this, Pooja. Many students, Smitha, Hiral, Bandredi, Hitesh, Shakti, and even Devanshu, everyone is like small, right? Shorter. I think a couple of students meant longer as well, like Rahul and I think one person who just said moderate. Okay, but I think you guys have reasons for your answer, right? If you're saying shorter operating cycle, probably because you know that longer operating cycle will have more working capital requirements. And anyways, you want to churn it faster. More the number of operating cycles in a year, more number of the higher will be the net profit, higher will be the revenue. So definitely everyone wants a shorter working capital. Because longer the operating cycle, then of course you might mean that okay, you are taking more time, so less profit and more working capital. Shorter the operating cycle, that means more operating cycles in a year. Mind you, if I talk about, let's say in a scenario A, that my operating cycle is, let's say, a 90 days. So in 1 year, there are 4 operating cycles. But in a scenario B, let's say my operating cycle is your, let's say, 45 days. Now in that case, in 1 year, I'm probably looking at 8 operating cycles, guys. So I'm sure everyone agreeing that B would be preferred. B would be preferred. So with that thought in mind, let's try to understand this formula. Operating cycle. We are talking about once we purchase raw material and we convert this into the finished goods, it takes some time, right? So raw material storage period, work in progress holding period, and finished goods storage period. Do you agree that probably this is the time actually from the raw material purchase to the point of sale? Am I correct? And after that, you will get some, you'll give some time to get the collections. So probably once you purchase the raw material, once you sold the goods, that includes all the 3, R, W, and F. And then when you make a sale, then your accounts receivable or your debtors collection period can be evaluated. But we will be understanding how we calculate each of these: raw material storage period, work in progress holding period, finished goods holding period. So finished goods holding is like, it's not like that if you manufacture something and tomorrow it will be sold. It never happens like that, right? You manufacture something today and tomorrow it will be sold. There could be a gestation period. And that's what we are talking about. So raw material storage period, WIP holding period, finished goods storage period. And not only that, we add the debt. What we need to reduce is this. The credit period allowed by the creditors will be reduced here. Guys, so let's quickly have a look at this illustration at the bottom. I want you guys to quickly read through this. So what are we looking at here is Dhoni company holds raw materials on an average for 45 days. It gets credit from the supplier for 30 days. Wow, that's a benefit you enjoy, right? And then we're talking about production needs 25 days. Okay, so you are talking about holding period of raw material is 45 days. Good. Then production takes 25. So 45 plus 25 is 70. Finished goods are further ahead for 15 days, so 85. And then we are talking about 45 days more for collection. So we are basically looking at 130 days of gross operating cycle. But when we are talking about the time taken or time obtained from our vendor is also 30 days. So we are looking at 130 minus 30 is 100 days. So 100 days is my operating cycle here. Is everyone with me on this in this example? Any doubts, please let me know. Any doubts, guys? Let me look at the query panel. Okay, great. So I think a lot of students have just confirmed that there are no doubts. Great. Good, guys. So now it's an interesting slide, right? It's all about time. Time is money. Money is time. So what will happen? Your every action will have a reaction, right? So we're talking about every action. We'll be talking about a reaction here. So let's say if you're talking about collecting the receivables faster, we get a shorter operating cycle. The cash is released earlier. Slower, you will definitely make the operating cycle longer here. Get better credit from suppliers. That means higher term. So probably in that case, your operating cycle can get lesser because you are talking about reducing those number of days. That's very important, right? Now, then we are also talking about shifting the inventory faster. That means churning my inventory, trying to sell my inventory faster. Of course, I will be freeing up the cash, and faster I churn up my inventory. We are talking about again, operating cycle can be reduced. But if you're talking about selling the inventory at a lesser pace, keeping on hold on more and more of goods, we are talking about consuming more cash and probably our operating cycle will increase. So that's about it. Now let's look at all these formulas, guys, in terms of the working capital cycle. I want everyone to just have a glance at this formula. Now there are two ways of looking at it. Either we kind of do a memorization or we understand it. So what does these formulas say? That all the components of working capital, how do we calculate them? Let's first look at raw material storage period. So raw material storage period, this is talking about average stock of raw material upon average cost of raw material consumption per day. What are we trying to say here, guys? Can we simplify it for us? How do we calculate the average stock of raw material? How do we calculate that? Can anyone tell me? Average stock of raw material? Any thoughts? First of all, also understand that we are talking about an amount here. That means average stock of raw material. Probably we are talking about dividing that by average cost of raw material per day. That means average stock of raw material will be as per the company policy. Am I correct? Smita says opening plus closing upon. That's fine. So Smita, I'm just basically casually asking that average stock of raw material will be based on the company policy. But if I talk about average cost of raw material consumption per day, think logically. If I give you annual consumption and we divided that by 360 or 365, don't you think it will give me average cost of raw material consumption per day? So if I divide my average stock, which is an amount, divided by the per day cost, we will be getting number of days, right? Answer will be number of days. What I'm trying to convey is that there is one way we can look at these formulas as a load on us. On other way around, we can understand these formulas and make life better for us. So that's absolutely correct. So that says it will depend on the efficiency of the company. So guys, everyone with me? I'm trying to make this formula simple for you. Similarly, if you talk about, let's say, the receivables collection period. I'm sure you guys have studied this in the ratios also, right? Receivables collection period. Your 360 upon account receivables turnover. And that's what we're talking about. Average receivables upon average credit sales per day. So we're talking about like credit sales upon 360 or 365. And we divide the average receivables by that. That means we are talking about the exact number of days of debtors we are having at the balance sheet date. So these formulas don't overload the formulas in terms of memorization. Keep it simple, guys. Keep this discussion absolutely simple for your purposes. Let's do one thing. Instead of pondering on these formulas, let's do a quick illustration. Let's try to understand how we can crack this and how we can actually keep our things simple. What we need to focus on is what exactly we need to calculate. Raw material storage period, work in progress holding period, finished goods storage period. So let's look at this illustration together. So we have to calculate net operating cycle and number of operating cycles in a year from the below information. And they're talking about keeping a 360 days in a year. Great. Now, we are looking at raw material inventory consumed during the year. 12 lakhs. Average stock of raw material is 1 lakh. Guys, what was the raw material holding period? You can look at that. Average stock upon average cost or average consumption per day. We are talking about the numerator here. That's fine. So are we talking? Are we able to get the denominator side of things? Average cost of raw material consumption per day. We are getting the raw material consumption for the entire year. That's what we needed. So that means we are talking about this 1 lakh upon 12 lakhs upon 360, guys. Am I correct or am I correct? This is what we are looking at. Because what it will give us is the per day consumption cost. What's the amount? Can anyone tell me the amount here? So everyone is telling me in terms of that is the 30 days here. Great. Okay. Next is your, apart from the raw materials, we also need work in progress holding period. Now, what is work in progress holding period, guys? Average WIP inventory upon average cost of production per day. So we have average WIP inventory with us. Cost of production for the entire year is given to us. So again, we are talking about a calculation piece. We just need to do this calculation, 50,000 upon. So we're talking about 10 lakhs divided by 360. So what will be the amount, guys? Someone said 18 days here. Smitha, 18 days over, right? Achha, you are just calculating that fraction of the denominator. You don't need that, right? You don't need that. Just straight away calculate whatever the number of days it comes. So 18 days. So that's fine. So guys, everyone getting it? So we get the raw material holding 30 days and the WIP holding 18 days. And the next in line, we have the finished goods storage period. So average stock upon average cost of finished goods sold per day. So we're talking about a finished goods inventory, 80,000. And then we're talking about finished goods sold per day. So are we talking about 16 lakhs divided by 360 here? This is what we are looking at. Am I correct? So probably we are looking another set of 18 days here. Guys, I can see some of you are calculating the denominator separately. I am not sure that you actually need to do that, right? If you put that in the formula, you don't need to do that calculation, right? So why to exactly calculate that? That's what my point is that if you plot that into the formula, rather than calculating at first stage, you will not get into points, right? So we have got 30 days. We've got 18 days. We have got 18 days. That was raw material to finished goods. Now we are talking about the next section. This is receivables collection period. So we are talking about average collection from debtors. We're talking about average credit period availed. So this is anyways given to us. The next two are anyways given to us. So average collection period is given to us as 45 days and average credit period avail is minus 30. So what are we looking at? So what's your operating cycle, guys? So operating cycle seems to be 81 days. 81 days, guys. Everyone with me on this? I'm just giving you 1 minute to absorb this. I'm sure everyone is comfortable. Now, the other part of the question is how many operating cycles in the year? So my operating cycles in the year will be 360 divided by 81. So probably looking at 4 plus. So guys, what I'm trying to say is we do not need to make those formulas too technical. Apply the simple logic. Try to understand that. And then you will find this easy. Yes, Vinod. Vinod is asking me about cost of production we consider in the WIP. Because what we are talking about in WIP is average WIP on average cost of production per day, right? So we will be considering the cost of production only, na? Because that's what it is in WIP, which is not yet complete, which is still under production. Great, guys. So I think everyone can probably match their answers. Everyone can match their answers here. Okay, so next we move on to a very important aspect of calculation of the working capital. So when we talk about the working capital cycle or operating cycle, you also need to understand how do we calculate the requirement of working capital. But my question is, we always call it as okay, working capital is the current assets minus current liabilities, and hence we need to calculate what is that the company wants at the end of the year. How much inventory do they need? How much WIP they might have? What is the amount of finished goods they need? And probably we know that finished goods can be coming in from their estimate of the production requirements and sales requirements. Based on their credit policy, how much will be estimated debtors? So what we need to calculate is each component of current assets and each component of current liabilities. And when we subtract, we get a working capital. But it would have been so easy, right? If it was limited only to this. Guys, do you agree with me that sometimes, as per the company policies, if they want, they can keep some buffer also? It's up to the companies, guys. We will discuss various policies, aggressive, conservative, and so on. So probably companies can keep a buffer also, right? They can keep a margin as well. So we'll talk about this in this. Let's talk about this one by one. Components of working capital. First, we are discussing the inventory part. Now, inventory is we are looking at three different aspects: raw material inventory, WIP inventory, and finished goods. And of course, we are talking about manufacturer here. We are talking about manufacturer. Look at the inventory formula. Again, don't get yourself overloaded with formulas. Try to understand it. It is pretty straightforward. Look at this, guys. Estimated production divided by 12 months or 365 days. What will you get, guys? Estimated production per month or per day. That is multiplied by average raw material storage period. That is based on the company policy. And you multiply with the price also, with the rate also. You will get what is the raw material inventory in amount you need to keep. Guys, everyone okay? Raw material inventory is clear to everyone? WIP inventory. Now WIP may, we're talking about estimated production upon 12 months or 365 days. That means estimated production unit per day multiplied by average WIP holding period. So that means number of days or number of units across the across the company policy or across those particular weeks. We multiply that by cost per unit. So we get an amount. So basically when we are multiplying this into the cost per unit, we are just arriving from the quantity, we are arriving to the amount. Siddharth says, why to multiply with average storage period? Siddharth, my point is, what did you calculate? Estimated production divided by 365 days, right? You just calculate the requirement only for 1 day. Will company, it depends on the company, right? Company may want to carry a raw material for 25 days. They may want to carry a raw material for 40 days, 2 months. It's a company policy. So you have to multiply with those number of days. For those, you need to keep the stock. Like we have a talk, concept of a safety stock, right? Shakti, I just explained that while I was answering Siddharth's doubt. Is your doubt also clear? Shakti, you also asked the same point. So Shakti and Siddharth, both of you are clear or not? Can you please confirm? Great, thanks, Siddharth. Shakti, from your side, any further doubts on that? Actually, it's good you are clarifying on the first point, because I think most of you will realize if you understand the first formula, you will understand all other formulas very easily. I can repeat one more time for inventory. Guys, if I see estimated production units, now mind you, this is for raw material, right? Let's say I tell you that one finished good requires 2 inputs of raw material. So you will multiply that by 2, right? If one finished good requires 2 inputs into your annual units of productions. So basically make sure that when we're talking about estimated production in units, so we are talking about in terms of the raw materials required. So be careful, guys. We will be talking about some questions, but we need to be careful what exactly they're asking and what kind of information is given. So estimated production upon 365 days is giving you 1 day raw material required for production. When you know the company policies to keep number of days of raw material in stock, you have to multiply with that, and that multiply by the cost gives you the amount. I think everyone here is very much comfortable when we multiply by the cost. That is giving you the amount. So if you understand the first formula, WIP is also the same, guys. Estimate production upon 365 days. And you need to see that company policy is to keep a WIP for 1 month, multiply that by 1 month and multiply with the production cost per unit. Finished goods. Again, the third time. You need to know, depending on your sales and production time, sales requirements and production time, that you have a company policy of storing some finished goods always, average storage period, and that multiply with the production cost per unit. Now, mind you, in terms of the raw material, we had estimated cost per unit. In terms of the WIP, we had estimated WIP cost per unit. And in finished goods, we're talking about estimated cost of production per unit. Of course, raw material, you will get the cost from the vendor or whatever agreement you have. WIP, you will have your material, labor and overhead. But cost of production could be the complete cost of finished goods. Rupesh, that's fine. Rupesh says leap year 366 days. That's absolutely correct. That's fine. No doubt in that. Guys, everyone okay on inventory side? Everyone okay on inventory side? 3 types of inventory here. Raw material, WIP and finished goods. Everyone doing fine from inventory perspective? We can talk about now amount of receivables that company wants to anticipate to keep. Look at receivables, guys. Estimated credit sales in units upon 365 days. That means we are right now looking at per day credit sales. If I multiply my average collection period, let's say company is giving you the data is 30 days time. So that means per day credit sales into 30 days will be the receivables, guys. Am I correct? Rahul, unfortunately, Hindi is not a possibility here. I could see Rahul requesting me to repeat in Hindi. But Rahul, please understand there are many students from southern part who may not understand that. Okay, so guys, I want everyone to be careful in debtors. Till now, everyone is okay. If I divide credit sales upon 365, that is per day credit sale. And if I multiply that into collection period, that is the number of units in terms of the debtors. But the most important part is here, although we make sale to the debtors, guys, everyone understand this. When you make sales to the customers or debtors, do you sell at cost or do you sell at selling price? What do you do? When you make sales to the debtors, what do you do, guys? Do you sell at cost or do you sell at selling price? I think everyone is very uniformly telling me that you're selling it at selling price. That means debtors. So debtors amount in the books of accounts is at selling price. Am I correct? Is part of the sales amount. Debtors in the balance sheet generally is at the sales price. However, understanding our working capital requirement, guys, selling price includes profit. And what we are calculating what is my requirement for working capital. That means what we need to know is how much funds do we need. Do you really include the unrealized profit as a blocked cost? I don't think so. If you think logically, the profit which is there in the amount of debtors is not your cost blocked, right? Is what you are expecting to earn. That is why we multiply the debtors units with cost of sales, even excluding depreciation. That means, can we say cash cost of sales? Cash cost of sales, because depreciation is also, there is no funds involved, right? It's a non-cash item. I want you to understand, for debtors, we multiply the number of units by cost of sales excluding depreciation and not by the selling price. Because although technically speaking, my financial statements will have debtors that is part of the sales, but here we are calculating the working capital requirement. That means we are talking about the funds blocked. So for debtors, even for finished goods at times, we might consider the cash cost, that is exact funds required. That means what we need to understand is what is my real funds requirement. Everyone okay here? Everyone understood it? Now, having said that, so debtors we will be careful. We'll be talking about some examples, but we'll be careful here. Now, the next element is cash and cash equivalents. It depends on the company to keep a minimum desired cash and bank balance. Could it be other examples also? There could be some prepaids as well as part of the current assets. So guys, everyone okay with the current asset side? Okay, Siddhant wants to understand receivables again. Siddhant, you make sales to the debtors at selling price. But when you try to understand the working capital requirements, you are talking about what funding you need to raise. Do you invest the profit in the working capital or no? I don't think so. Working capital, it's the amount of funding you need to raise, right? And working capital is current assets minus current liabilities. Technically speaking, debtors are recorded at sales. I'm not changing you. I'm not asking you to change your books of accounts. So basically, what we are trying to understand that for calculating the receivables, what are your real funds blocked in the receivables? Your funds blocked, not what is due from debtors. Company blocked funds in receivables are in terms of cost. Company is receivable from debtors, that's selling price. The difference is profit, right? Profit is not part of the working capital, right? It's not your funds blocked. Okay. Now we are talking about, Vinod says, what about depreciation? Depreciation is a non-cash, right? Depreciation is a non-cash. We consider cash cost. Hiral is asking why finished goods, the depreciation is not deducted from the total cost. Hiral, we will consider that. It's not directly reflecting in the formula. We will consider that while we'll be doing the examples. Okay, so Siddhant, Vinod, Hitesh, everyone okay doing fine? Any doubts? Please let me know. Anyways, thanks for being proactive. Whatever clarifications you are doing, guys. Great. Now, can we just quickly look at the creditor side as well? Very important, guys. Creditor side. Now, on the current liability side, we have trade payables. Here we are talking about the requirement of credit purchases per day. But please try to see that here we are multiplying that, or rather we don't need to multiply that by the cost, because we are just talking about the estimated credit purchase upon 365 days. We are not calculating the number of units here. That multiplied by the credit period available by the suppliers. That's it. That's what we are talking about. In case we are talking about number of units, then you will be multiplying that by the purchase price. If they're talking about in units, then you will be multiplying by the procurement price, the purchase price agreed with the suppliers. Vinod says, I know, sir, but how it comes while calculating the receivable? Okay. Vinod, just tell me, when we talk about receivables, you sell the goods at the selling price, right? This is what I was discussing. And how is the price, the selling price, right? Cost plus profit. And what gets included in the cost? Depreciation. Also, cost of production also includes depreciation, right? Vinod, that's fine now. Because you are selling the goods at the selling price now. Think about cost sheet. All the cost, material, labor, overhead combining to the total cost, and then we are adding the price, and that's the selling price. So Vinod, I hope that makes sense. Okay, so guys, coming back to creditors. Creditors okay to everyone? Here we are talking about the purchase price. That's it. Direct wages, guys. Also, sometimes what may happen is your operating expenses like wages or any other, like any direct any other expenses which are paid on a lag, right? Which are paid on a lag. Let's say you pay wages, let's say 1 month later, or 7 days later, 15 days later. So if you're talking about paying wages 15 days later, that is the time you will be enjoying, right? That is the time period you benefit. You can use those funds somewhere else. So you will reduce the current liabilities accordingly. And hence, that is a very important source of finance. Even the overhead, guys, any other expense, overheads, but other than the non-cash ones. Your estimated overheads upon 360 multiplied by the average time lag. Vinod, I never said projections. They're not talking about projections here. I'm just telling you that, okay, how does the selling price get arrived? Think from that perspective. Give me a second here. Let me just use that space in the margin to explain you. So what we are talking about is, you talk about material, labor, overhead. That's your cost of production. Then you add the profit element. You talk about selling price. Then you sell to the debtors, it's selling price. What we are doing is looking at the actual cost involved, and not only cost, but cash cost. So what we need to do is, we eliminate the profit, and out of this cost, we also eliminate the non-cash items like depreciation. Thanks, Vinod, for confirming. Great, guys. Amazing. So I think everyone got it, how we are calculating these components. So this is a quick table for your reference. Estimation of working capital requirements, guys. We talk about the inventories. We'll calculate raw material, WIP, finished goods. Then we talk about the receivables. This is called as gross working capital. And then we talk about current liabilities, trade payables, overdraft, expenses payable. And we talk about that as a current liabilities. And I want everyone to kindly focus on something which is called excess of current assets over liabilities. This is not named as working capital yet. I have a question here, Smita. Smita says in calculating the cost of production, non-cash cost expenses is excluded. Yes, Smita, wherever you will be given that, you will be talking about the excluding the non-cash for debtors and finished goods specifically. Because that's where you are talking about the total cost. Am I correct, Smita? That's the area we are talking about the total cost, right? So we will be excluding that wherever given to us explicitly. Okay, so guys, everyone okay here? Current assets minus current liabilities is not yet working capital, but you can see what they are doing is add the safety margin. So let's say, for example, the working capital is kind of coming across is 50,000, and the company wants to keep a kind of a safety margin of 20% because like your estimations may go for a toss. So you may say that okay, my net working capital is actually 60,000. So logic of margin of safety is clear, guys. You want to keep an extra buffer. Now, I want everyone to just quickly look at a note at the bottom where we're talking about if any organization wants to operate in double shift. And we will look at that example later on. What do you think? Double shift means more effective utilization, efficient utilization of the fixed assets. You may need more working capital. But the point is whether if the organization decides to operate in a double shift, do you think the working capital requirement will double in exact proportion? Yes or no? Let's say a factory is operating in 8 hours and they are needing the working capital of 1 lakh. If they operate 16 hours, do they need working capital of 2 lakhs or not? What do you think? Will the WIP requirement exactly double or there could be some efficiencies? I think there could be some efficiencies, right? You may not exactly require the double the working capital. What do you think, everyone? Here has a question, why the safety margin was added? Here because these are more from a perspective of calculation of the working capital requirements. What if the actual situation turn out something else and you are not having any buffer? Here as part of the company policy. So same question can apply, why the company is giving 30 days credit, right? It's a company policy. Okay. So Shakti says, can you please explain safety margin? Shakti, it's a very coincidence going on today, right? Your doubt comes in with another student and you guys are generally asking the same doubt. So when Hiral asked, I saw your doubt now as well. I think both of you are sorted. Safety margin is clear, guys. Okay, coming back to the point of, do we need a double working capital? No. Pooja says no. Even Siddharth says there will be efficiency as there is element of fixed cost. But also, guys, what about WIP? Yes, I agree, guys. There are a lot of efficiencies. Think about your arrangements with the vendors. You will be purchasing the double the raw materials. They might give you discount, right? They might give you discount. You may get better deals because you are increasing your volumes. So because of that efficiencies, you will be saving in some cost. What about WIP? You know, WIP will remain same probably because if you are talking in double shift, whatever units are pending in shift 1 will be continued in shift 2 will be completed, and at the end of the shift 2 we will be having the same number of units. A very, very important point here. WIP shall be completed from the first shift to the second, and the closing WIP shall be from the second shift now. So probably it will not change. Is everyone okay here? Why with a double shift your working capital may not be exactly doubling in? Everyone okay here? Pooja, yes. Okay, guys. So I think I just realized that it's 7:20 now. Let's do one thing. Let's take a 10 minutes break. On the other hand of the break, we will be needing to do some practice on working capital calculations. We'll try to do a couple of questions and move ahead. So let's take a 10 minutes break right now, and then we will continue, guys. See you after the break. Welcome back, students. So we had a good mind-throbbing session before the break, understanding the working capital policies, understanding the operating cycle, how do we calculate the working capital, and while we ended the session, we had a discussion on something called double shift. Now, Smita had a question that what are we talking about here? Smita, what basically I was explaining is that if I'm talking about operating in double the volumes, do you agree that I will be probably bringing in more efficiency? I may still have some capacity, right? So my point is that if I want to double the volume, do I need to double the working capital in that same proportion or not? I don't think so. I give you an example. Let's say my creditors may give me a better rate. I will be in a point of negotiating the quantities. Am I correct? That would be good. I could negotiate the quantities. What do you think? And also in terms of the WIP. So we're talking about two things, that process efficiencies, better negotiations from the customer, from the creditors, from a deals, from a rate perspective, and also WIP. If we talk about the WIP shift one, will continue to the shift two, that will be completed first, and by the time the shift two ends, you will have the same WIP. So it will not be the double, right? So basically, in terms of the requirements, the working capital may not be exactly in the double the proportion. Okay, so let's move on, guys. We need to do some practice here, and we look at the first practice question. So we're talking about the managing director of Bhavani Limited is curious to know the amount of working capital that will be required during the year. So we need to calculate this working capital based on the information given to us. So we are talking about production during the previous year was 1,20,000 units. It is planned that this level of activity would be maintained during the present year. We may need this information for calculating our inventory requirements. You're welcome, Komal. I was seeing your comment on the query box. That's absolutely fine. Yeah. So we are talking about raw materials are expected to remain in store for an average period of 2 months before issue to the production. Expected ratios of the cost to selling price are raw materials 60% here, direct wages 10%, and overheads 20%. Wow. So probably we are talking about 10% of profits. Am I correct? Because cost to selling price is 60, 10, and 20. So probably 10% of the profit. Siddharth says it means we can't say accurately. Siddharth, I did not say that, right? Probably by hook or crook, you would have different means of calculating the WIP by getting the information from your engineering department, from the market study, right? So, Siddharth, is it good? So we are not talking about that. Okay, we cannot accurately. Of course, see, at the end of the day, if you're talking about 100% perfection and accuracy, that's why we are talking about the safety, right? Margin of safety. So each unit is expected to be in process for 1 month. That means the company has given you that probably you need a WIP for 1 month. We are talking about raw materials being fed into the pipeline immediately, and labor and overhead cost accruing evenly during the month. Now, this is very interesting. I'm talking about WIP, which is probably in process in 1 month, wherein the raw materials being fed into the pipeline immediately and the labor and overhead costs are accruing evenly during the month. So this information could be very handy when we are talking about computation of WIP levels. We will be considering this information as WIP because we are talking about WIP consists of material, labor, and overhead. Finished goods will stay in the warehouse awaiting dispatch to customers for almost 3 months. So let us look at this. We are talking about raw material, 2 months. We are talking about WIP, 1 month. We talk about finished goods, 3 months. I think many of you were asking about this earlier. This is all is given to us. They talk about credit period allowed by the creditors is 2 months from the date of delivery. Credit period allowed to debtors is 3 months. That's not so good. And there is a regular production and sales cycle. Selling price is 5 per unit. So that means the raw material would be ₹3. Wages seems to be 0.5 per unit. And overhead seems to be 1 per unit. Am I correct, guys? This is what given to us. Wages and overhead are paid on the first of the each month for the previous month, and the company normally keeps the cash in hand to the extent of 40,000. That's good. Let's do one thing. I want you guys to try this question along with me. First of all, what should we do? If we have to calculate the working capital, probably we need to start with the raw material, like inventory, guys. Do you agree? So can anyone tell me how do we calculate the raw material inventory? They're giving you 2 months of raw material inventory that is required. But how do we decide how much is the 2 months? Probably production for the year. Production for the year. So that means if I'm talking about 1,20,000 units, was the production, and you need 2 months of inventory of raw materials, that means you need 2 by 12 into 1,20,000. That is 20,000 here. Are we talking about this? Any thoughts? And because the raw material cost is 3, we can multiply this 20,000 into 3 and we'll get 60,000. Hitesh, I think you need to check. You need to check. There is some calculation. I think I am getting raw material inventory as 60,000. Everyone else, can you please double check? Hitesh, could you check it? Why are you multiplying with 5? I think that's the problem, right? Oh, you have done that. Okay. I think what you missed, I think that means what you missed is dividing by 12, I guess. You're multiplying into 2, but that was the yearly production, not monthly production. So divided by 12. Is everyone getting 60,000 for the raw material inventory? Okay, can we talk about the inventory for finished goods? I think finished goods maybe we have 3 months. So we're talking about 120,000 into 3 months into 4.5 now. Now in this case, we seemingly don't have, I think Smita, to your question you were asking me earlier, we don't seem to have a depreciation information for us, right? So obviously in the absence of information, we cannot assume something real. So we are talking about cost here, not the cash cost specifically, because they're not giving us anything about it. So 3 by 12 into 1,20,000 into 4.5. So from a finished goods perspective, I'm looking at a 1,35,000. I don't know how many of you got that 1,35,000. I'm going in pretty slow here so that everyone is with me. I want to take you guys, everyone, all together in this journey. Can you guys please confirm for finished goods? Let me know if any doubts. Hiral, we are not even multiplying with 5 now. We are multiplying with 4.5. Or if you would have multiplied by 5, you can multiply that by 90% because your cost is 60 plus 10 plus 20, 90%. So it's like different way of calculating the same thing, right? What about this? Any doubts till now? Okay. Now we move on to the WIP part. Guys, I want everyone to be careful. WIP is required for how many months? 1 month. That's given to us. But do you agree that within WIP, we are talking about material, labor, and overhead? The WIP comprises of material, labor, and overhead. So what about material? Material is fed into the pipeline immediately. Do you agree that means for WIP, we are talking about 1 month raw material will be stuck? So can we say 1,20,000 into 1 by 12 into 3, 30,000 here? Everyone with me on this? That's a 1 month raw material part of the WIP. I'm calculating WIP here. The other part here is, now I want everyone to pay utmost attention. WIP apart from the material also has labor and overhead, but look at the language of the question. Look at the language here. Labor and overhead cost accruing evenly during the month. That means some part will be incurred, labor and overhead will be incurred on 1st of March, 2nd of March, 3rd of March, 13th of March, 18th of March, 24th of March, every day. Guys, do you agree with me? Labor and overhead are accruing evenly during the month. So some part of the labor and overhead is spent on first day, some part is only spent on the last day. Evenly. That means we have 30. How many units we have, by the way? So on 10,000 units, we are talking about labor and overhead which are evenly throughout the month. Now we don't know how many units labor and overhead were incurred for 30 days, how many units they were incurred for 29 days, how many units they were incurred for 24 days, 14 days, and so on. Can we take an assumption that because labor and overhead, if I'm talking about, let's say, entire month, this is 1 month, the labor and overhead is spread across the month, guys. Can we take a safer assumption that the entire labor overhead is spent at the middle of the month? Can I take that assumption? Because it was spent evenly throughout the month. Can we take that assumption, guys? That's the middle of the month. Hence, while we calculate this, we multiply that by labor and overhead, which is 1.5 rupees. We multiply that by 1.5, but because it is evenly throughout, we will multiply it by 1 by 2 as well. So I am getting a labor and overhead of 7,500, and hence my WIP seems to be 37,500 on the top. Everyone, guys, how are you feeling right now? Probably some of you are kind of trying to digest it. Some of you are like more like getting some kind of a shock treatment that what was this? Keep it simple, guys. The language was a little tricky. The labor and overhead cost accruing evenly during the month. So that means across all the 30 days, some part of the labor and overhead incurred. We don't know, should we take for 30 days? Should we take for 2 days? Should we take for 7 days? I took it up because it was evenly throughout the year. I took it for the mid of the month. That kind of takes care of the labor and overhead initial part of the month and later part of the month. Siddharth. Yes, Smitha, absolutely. Smitha says, I have assumed that it is accruing in the mid of the month. So Siddharth, if labor and overhead is incurred on every day in the last month, so that means if I want to calculate for all the 30 days, I will be doing like 30 by 30, 29 by 30, 28 by 30, 27 by 30, 7 by 30, 6 by 30, 5 by 30 every day. So we know 15 days this side, 15 days that side, it is evenly accruing. So can't we do 15 by 30? 1 by 2? If 1 by 2 is getting confused, you can do 15 by 30. If you are not comfortable with 1 by 2, we can do 15 by 30 because we are talking about mid of the month. Siddharth, is it clear now? Prabhas, it's not assumption, it's given in the question that these costs are accrued throughout the year, throughout the month, evenly throughout the month. The word is evenly, na? They've given in the question. So Prabhas, nothing to assume, na? They are giving in the question. You're just doing it as an average because otherwise you have to calculate for all the 30 days. So guys, everyone okay with 37,500? Everyone okay with 37,500? Now, can we move on to the next level? That is your receivables. Debtors. Can we talk about debtors, guys? Now, what are the total sales we are looking at for debtors perspective? Someone said, why we multiply by 1.5? Siddhant, 1.5 is labor and overhead. Na? Direct wages is 0.5 and labor is 1. 10% of the selling price and 20% of the selling price is total 30% of the selling price. Siddhant, does that make sense? So 5 into 30% is 1.5. Yeah, Prabhas, that's fine then, if you meant that way. Okay, so now we talk about the debtors. So debtors we are talking about 3 months, right? Somewhere it was mentioned credit allowed to debtors is 3 months. Now, if I have to calculate the debtors at the bottom, I'm talking about 120,000 units. Selling price is 5. So total sale is 6 lakhs. But we are worried about the cost of the sales. 6 lakhs into 90%, 5 lakh 40,000. And we are talking about 3 months credit, 3 by 12. So seems that debtors are coming out to be 1,35,000. 1,35,000. And I think cash and bank is given to us anyhow. Vinod says, For the time we forget the period for considering finished goods and WIP, we take total 4.5 unit both. You could say that, that's absolutely okay. I know what you're trying to say, that for the finished goods we use 4.5. Even for WIP we use 4.5, but for WIP we calculated material and labor overhead separately because of that time issue. That's fine. See, because finished goods are, see, holding period is different, right? Holding period is different, that's it. So probably that WIP is equivalent to that period of finished goods. I would say that. Of course, the material, labor, overhead, everything goes into WIP as well, but it's like not complete. Okay, so I think everyone got debtors at 135 and bank balance is given to us as 40,000. So what is my gross working capital, guys? What is my gross working capital? That means my current assets. 407,500. That's what I'm getting. Siddharth has a very interesting comment. Siddharth says, in this question, debtors was easier to digest than WIP, but now they are clear. So Dhanshu says, in debtors, we can't take cost of sales is okay. So basically, so Dhanshu, that's what we did now. We multiplied 5 in, like I multiplied that by 90%. 5 into 90%, 4.5. You could have straight away multiplied by 4.5. I'm fine. I was explaining that how we arrive from sales to cost of sales. That's why I did it. Okay, now we move on to the liability side. We now move to the liability side. What do we have? From a current liability perspective, we have a creditors, who are giving us 2 months, I guess. So 2 months purchase. So if I talk about calculating the creditor side, we're talking about 120,000 is for the entire year. How do we calculate the creditors, guys? So we are looking at 2 months, that is 120,000 to 2 by 12. That's 20,000 into 3. That's the price for the material. That's the creditors. Similarly, we are talking about wages and overhead are paid on the first of the each month for the previous month. So what are we trying to say here in terms of wages and overhead? Again, 1 month here. We are carrying 1 month outstanding. Guys, everyone with me on this? Wages and overhead. So we're talking about 120,000 into 1 by 12, 10,000 into 1.5. Is everyone getting 15,000? So hence your total current liabilities are 75 here. And my working capital required is, they have not given any safety, I guess. So we're talking about 332,500 on the top. And I'm sure everyone can validate their calculations from here as well. Those of you got 332,500 already, it's a good job. Siddharth says direct wage is 10%, right? So 0.5. Yes, absolutely. So Siddharth, we are talking about both labor and overhead. Na? So it was not only wages, it was overhead also. That's why we multiplied by 30%. Everyone okay, guys? All got 330 to 500? Yes, Siddharth. Yeah. We have taken it together. If you want to take it separately, that's fine. Great. So guys, now on the similar lines, can I expect you to guys to do a homework? This is your assignment. This particular question. The good news is, the good news of this question is the last line. Ignore work in progress. Very similar question, what we have just solved. The only thing is, we need to understand that how do we do this all calculation aspects. That's what we need to consider. That's it. Everything else looks good. Couple of things which also you need to keep in mind while attempting this question about the cost. So I think Vinod was asking this question earlier. Vinod, in terms of the total cost versus the cost for the purposes of WIP. In this particular question, we are talking about material, wages, cash manufacturing expenses, but we are also talking about administrative and sales promotion expense. So basically what is happening is, on one hand, you have cost of sales, which will be required for a debtors. On other hand, we are talking about finished goods, and WIP is anyways not the concern here. But on the other hand, we have the finished goods. So here for the finished goods, we are only talking about material plus labor plus overhead. Hiral is coming with the question on the last doubt on the last question. Hiral is asking, why did we do in the last question assignment here, but I'm also giving you a tip how to go about it. Work in progress has to be ignored, that's fine. But we need to understand that when we are talking about finished goods, we need to take into account these aspects. But when we are talking about cost of sales, we are talking about all the expense, all the cost. That is for the debtor's perspective. Everyone with me on this? It's a very, very similar question. The only trick which it has, I've already shared with you. So I want you guys to try it on your own. I will definitely, upload another PDF with the solutions, and definitely you can refer to the workings later on. But I want you guys to try this on your own first. Take it granted, guys. You guys will be doing this. Time for hard work, right? Rather than hardly working. Everyone okay till now? Okay, so now we move on. Having said that, so this question you guys need to try on your own. I would like to move on to a very interesting question from your study material with respect to submarine enterprises. Submarine enterprises. Now, this particular question relates to a single shift and double shift. And Smitha and other people who are asking about the issues about, why or what happens when there is a double shift, we will be discussing in this. And that's why I'm taking up this question instead of the previous one, which you guys can attack on your own. So submarine enterprises has been operating its manufacturing facilities till 31st March 2017 on a single shift working with the following cost structure. Cost, wages. I'm very much interested in some aspects that they're talking about some part of the wages and overhead is fixed. So probably that means other part is variable, right? The other part is the variable part that we may need to consider. Profit, selling price. Wow. Sales during the year 2016-17 is 4,32,000. Can anyone tell me what were the number of units? Number of units? Are we talking about 24,000 units? That means? Because you will divide this sales by 18. So that's a single shift structure, guys. Also, they have given that on 31st March, the company held below aspects like stock, they have given, work in progress, they have given, finished goods, and sundry debtors. Amazing. So that was given to us. Now, what we are looking at is in the view of increased market demand, Janta's demand, it is proposed to double the production by working an extra shift. Now, when you do the extra shift, of course, you're talking about double the volume, right? Instead of 24,000 units, you might plan for 48,000 units. Okay, I'm getting some inputs with respect to audio versus video issues here. Guys, is it now working fine? May I request the IT team, can you please just check? I think it seems to be working fine at my end, though I can see that, but guys, can you please double check? Okay. So in the meantime, let's walk through this question, guys. I'm sure this will be pretty much sorted out. So it is proposed to double the production by working an extra shift. It is expected that 10% discount will be available from suppliers of raw materials in the view of increased volume of business. And this is what I said. If we are operating in the double shift, we want to double the production. Instead of 24,000, I'm planning 48,000 now. Probably I will be having to buy more raw materials. And in that case, yes, there will be a kind of an arbitrage or a benefit or a bargaining. I could do a better deal from my suppliers. Selling price will remain the same. Credit period allowed to the customers will remain unaltered. Amazing. Can anyone tell me what is the credit period allowed to the customers? What is the credit period allowed to the customers, guys? Who will tell me? Credit period allowed to the customers is what? Currently, in a single shift. Who will answer this? What is the current credit period allowed to the customers? At least try, guys. I think a lot of you are just going through the question that probably it's given somewhere here and there. Or I could give you a hint. Probably it could be derived from some of the information given to you. If you look at the information carefully, you might be able to derive that. Anyone would like to try? Okay, let me look at the comments here. In fact, no comments, no suggestions till now. Okay, I got the first one. Bandreti says 4 months. Bandreti, what did you do to calculate 4 months? What did you do? What about others? Okay, I think, let me help you guys if you are stuck. Pooja says 2.5 months. Bandreti says sales upon it. So Bandreti, my question is, it's amazing. So Bandreti was very, he is very smart, very intelligently. He did capture two information. Absolutely amazing, fantastic. He said that my sales are 4,32,000, but my debtors are 1,08,000. He arrived at 4. But Bandreti, can you say that 25% of your debtors are outstanding, are pending? Let me give you a food of thought. In fact, everyone, guys, let me give you food for thought. That does that mean the credit period is 4 months, or does that mean the credit period is 3 months? Bandreti, any thoughts? 4 months or 3 months? Prabhas, same question to you. Everyone is calculating like 4. Acha, that means 1/4 sale is pending. But boss, in a year, there are 12 months. If you are telling me 1/4 sales are pending in debtors, that means 1/4 of 12 months is 3 months, right? Any thoughts? Devanshu, good. Siddharth, Smita, everyone getting me, guys? So Prabhas, Bandreti, is it sounding good? It could be tricky, but I think that was a very good attempt. Those of you attempted the very first, I see. I don't mind that you got it wrong or right. At least you guys attempted, right? That's what mattered. Okay, guys. So credit period avail from the suppliers will continue to remain the 2 months. That's given to us. Lag in the payment of wages and expenses will continue to remain half a month. Wow. Now, so we're talking about that. We'll be considering this 12/4 situation. We'll be talking about this period when we come to that stage. We are required to prepare additional working capital requirements if the policy to increase output is implemented. Now, in this case, there are two approaches to this question. What I have covered in the presentation here, and I'm sure you guys can look at your study material later on. Either we are talking about working in double shift as a policy decision, or we can think that, okay, it is a one-off increased market demand and we're just working to meet the demand. What do you think, guys? The requirement of the question is to operate as a policy decision. Am I correct? We're talking about policy to increase the output. That's it. So I have just considered that, okay, if I'm working in double shifts and if that's my policy now, what is the working capital requirement? Because if it is one-off situation, then your calculation might slightly differ. I will tell you that later on. In fact, you guys will see that, go through that other part of the solution as a reference point. So I've covered the major part here. Now I need to kind of walk you through the entire situation here. Everyone got it that yes, my sales is 4,32,000. We arrived at the present volume of 24,000. That's absolutely correct. The closing stock was given to us. Closing stock was given to us 36,000, and hence, in terms of, we're talking about the units. We're talking about 6,000 units of closing stock. Can anyone tell me how did I arrive this? 36,000 divided by 6. 6,000 units of the closing stock. So 6 is your cost of materials. So we are taking that into the stock calculations. Closing work in progress. Now this is interesting. My work in progress is calculated at prime cost. This is given to us in the question. And prime cost is what? Prime cost is what? Material plus labor, guys. Are we talking about 11? And hence, we are talking about 2000 units. 22,000 divided by 11. Mind you, I told you guys, even if you move from a single shift to double shift, the number of units will be same. Because when the second shift start, these guys will be first completing the WIP of the first shift. So second shift will first complete these units, and then at the end of the second shift, probably you will have the similar number of units. So we're talking about 2000 units will be remaining the same. Now, of course, in terms of the closing stock of the finished goods, we are talking about valued at total cost, and my total cost is 16 because 2 was my profit, and hence we are looking at a scenario where my closing stock of 72,000 is reflecting 4,500 units. Guys, everyone okay till now? Everyone understood the units calculation for respective components? Any doubts, please let me know. Everyone okay, guys? Any doubts, please let me know. If it is all clear till now, kindly confirm. This is a good illustration. Okay, so now we want to understand what is the cost at the single shift when we are operating at 24,000 units. This was given to us in the question. That is what was talking about the selling price of 18 and minus the profit. We talk about the cost of 16 here. But what we are looking at is that we are splitting the variable and the fixed part in wages and overhead. Because what is given in the question is 40% fixed. That means 60% is variable, 3 is variable. Similarly, overheads 20% is variable, 1 is variable. Because do you agree that fixed cost will not change? Fixed cost will not change when we change the volume. Smita says why I took as finished units as 2000. Smita, 2000 is the units which I took only for WIP, right? For finished goods, we took 4,500. Smita, please double check. Vinod, this is exactly what I'm talking about. Vinod is asking me the same question. Can we know why we kept the WIP same in double shift? Vinod, just tell me yes or no. If there are WIP in single shift, as soon as the next shift workers come, don't you think they will first pick up the work in progress and complete those units? Yes or no? Prabhas, I absolutely echo with you. Prabhas says it's a detailed illustration. It's not so hard, but it is definitely checking your attentiveness. Absolutely correct. Smita, why did we take 2000? Because work in progress is given to us in the illustration of 22,000. Please refer to the information given in the table on the right hand side. Work in progress is valued at prime cost. Prime cost is material plus labor. Material plus labor. 6 plus 5, 11. So 22,000 divided by 11, 2,000. Raghavan, I may agree with you, but probably in practical life, you may end up into working in different departments, but that cannot be complicated in the ambit of the question here. So Smita, is it okay now? The 2000 is clear to you? Because in WIP, we are talking about 2000 units. Okay, and coming back to Vinod, I was asking you, and you replied that yes, the second shift people will come and complete those units. So then when the second shift will be over, they will be also, because they did not start, initially they spent some time in completing those units. So second shift will also have some units in WIP. So that will end up in the same units, right? So the idea is that it will not double. It will not be 4,000 in the double shift. It will be, we will be probably assuming the constant rate or constant speed of the production, and that will be 2000 itself. Vinod, I hope that makes sense now. Okay. So guys, I want everyone to focus on the cost statement, please. I want to focus, everyone to focus. This is very important. Now, we are talking about at 24,000, that is a single shift. My total cost is 16, which comprises of material, labor, overhead. But we have split the labor into fixed versus variable. We have split the overhead into fixed into variable. Why? Because as my volume will change, my fixed cost won't change. So for example, the wages are 40%, that is 2 per unit is a fixed cost. So 48,000 doesn't change. The fixed labor, the fixed wages, fixed overhead doesn't change at a total level. Okay, Smitha, then I think I accidentally answered your question when I was talking to Vinod, right? So your question is actually same as what Vinod asked. No, Vinod, actually, I'm talking about very logically, right? You know, we're talking about a scenario that, let's say, in a shift of 8 hours, you are leaving 2000 as WIP. And if we're talking about on a daily basis, we're talking about the shift, right? On a daily, it's not one day job, it's daily basis. In a shift of 8, and Smita, this is for you also. In a shift of 8 hours, I'm leaving a WIP of 2000 units. Probably in the 16 hours also, that will be the same, right? Because we'll be absolutely only producing the same finished goods. You may argue that, okay, probably that, the second shift may produce exactly all the units and there is no WIP. No, I will not agree, because we are only assuming only for one day. This is every day, right? Throughout the year. So that means that will be, so the first shift will be having the 2000 units from the last or early morning of the second shift, last day second shift. Vinod, Smita, is it now making better? The first shift will be also starting with the last day second shift 2000 units, and that's why it will be rotating in that sense. I know it could be a little tricky to understand, but here's the logic. Pooja says, how did we calculate per unit rate of double shift? Okay, Pooja, that is a very interesting question. You tell me, the fixed cost at a total level doesn't change, right? And we talk about the fixed cost of wages, 48,000, 96,000 overhead. And we at least, Pooja, we know this thing, that the double shift, the volume is doubling 48,000. So can we just divide the total fixed cost by the total volume? And we got per unit. So what I'm talking about is, guys, in double shift, what are the synergies we are getting? Or savings, economies. We are talking about a discount from creditors. We are talking about per unit wages going down, fixed portion. Similarly, per unit fixed overhead going down. Everyone with me on this? So that's a double shift savings. Double shift savings for us. Look at this raw material, 10% discount, 6 to 5.4. That was given to us in the question. 10% discount by the creators, by the vendors. And you did not say, did you change the selling price? No. Your selling price is 18, right? So per unit cost is 12.4. Selling price is 18. Your profit increased rapidly. Your profit increased from 2 per unit to 5.6 per unit. I'm going to quick calculation and quick clarity from everyone, guys. I can give you 2 minutes. I can mute myself, but I want you guys to speak out if you are not clear on anything. You can have a look. Let me know, guys. If it is all clear, kindly confirm. Pooja says, my doubt is 5.4, 12.4, 5.6. Pooja, creditors agreed to give you 10% discount. How much is 6 minus 10%? Pooja, 6 minus 10%. We're talking about 5.4. Is that sorted? And Pooja, if you're fine with all others numbers, 3, 1, 1, 2, then 12.4 is total. 12.4 is the total cost. Total of all the numbers above. And 5.6 is the balancing figure because 18 is my selling price. 18 minus 12.4 is 5.6. Here we are talking about variable cost because they have not given any savings, right? Variable cost. Okay, guys, here to add to your explanation, please understand variable cost per unit remains constant. That means total variable cost changes up and down, but the total fixed cost remains constant and the fixed cost per unit changes up and down. That's the logic, right, behind the costing. Now, like in the raw materials, they gave us some kind of information of discount. They have not given any information for wages, any bargaining with the employees or the overheads. No. So per unit cost will be constant, now. Here, that's the general rule of costing, right? So if I have this pen in my hands, if it costs me 2 rupees of a material to make it, whether or we talk about from a perspective of 10 pence or 20 pence, we are just using the same variable cost. Only reason in this case we changed the material because they were given in the question of 10% discount from creditors. Here, is it okay now? I think a lot of doubts, a lot of clarifications, but I think what we say is all is well that ends well, right? Everyone getting some clarity, so it's good. And I think I'm glad that I took up this in the class. Everyone okay here? I hope no queries are unresolved as of now. Can we move ahead? Hiral, your questions are sorted. Smita, Vinod, and anyone else? I think Pooja confirmed. Siddharth is okay, I guess. Siddharth, you're fine? Siddharth, you had a question of 48,000, I guess. You're okay. 24,000 single shift. We just double it. Vinod, we just took the total fixed cost same. The wages split was given to us, na? If you see the question, if you see the question table, in the wages and overhead, they've given you the bracket may, out of which 40% fixed and out of which 80% fixed. So we took that 48,000. This 48,000 went to 48,000 as is. This 96,000 went to 96,000 as is, and it was divided by larger number of units. Hence, the per unit cost come down. Hiral is saying still confused. Hiral, what is variable cost? That varies with the production. Do you know that? Variable cost is the cost which varies with the production. So if the cost to make one toffee is 2 rupees, so what is the per unit cost? 2. Cost to make 20 toffees is 40 rupees. Per unit cost is again 2. 40 divided by 20. Here just think it that way. Variable cost has to be same per unit. Unless they give you some savings, like they gave you for the material, there was a 10% discount. Vinod, is it sorted for you? I think you were not sure of the where we are getting the fixed numbers from. Okay, guys. So I think we need to move on. Otherwise, we're stuck on only one page. Okay. So Siddharth, let us move to the calculation and then we'll talk about debtors. Okay. So guys, now we are talking about the working capital requirement for single shift and double shift. Mind you, as far as the information in the question itself, they're talking about the raw material, 36,000, WIP 22,000, finished goods 72, and 1,08,000 sundry debtors. Can we say that we can take that information as is? The only point is what Siddharth just asked about debtors. Siddharth is asking about debtors. How come the debtors got changed? So I think Siddharth, your timing of asking about debtors was wonderful, right? The debtors were given in the question for 72,000. Right? Sorry, 1,08,000, not 72,000. 1,08,000, right? But the point is that that was based on the selling price, probably 18. Siddharth, it was mentioned for the selling price when we talk about debtors, because that is now, but we need to talk about at cost. My cost is 16 over there, right? So what we need to understand is, in terms of the debtors, we are talking about 6,000 units, because we talk about 1 by 4 of 24,000. Please try to understand. $24,000 divided by 4, 6,000 units, and we multiply it by 16, not 18. Siddharth, are you getting it? Because we are calculating working capital requirement, not the working capital in financial statements. So guys, 2,26,000 is my total current assets in the single shift. I'm only operating in single shift right now. And they're giving you information in the question itself about creditors. For example, creditors are talking about 2 months. 2 months means how many units? 2 by 12 multiplied by 24,000. Hence, we are talking about 4,000 units. That's creditors for us. So everyone okay here? 4,000. And the price was 6. So we arrive at 24,000 creditors, guys. Wages and expenses, both were talking about half a month. Half a month. So 24,000 into 0.5 upon 24. Or sorry, 12. 0.5 upon 12. So we are talking about 1,000 each. So that's the previous question. We did not have profit. Yeah, that's fine. So Siddharth, in the previous question, we just added the cost now. That's why. We never reached to the profit stage. That's why. Okay. So guys, everyone okay with these units of creditors and wages? 4,000 and 1,000? And these rates are being taken from the cost statement 655. Here we are not kind of splitting into variable and fixed. These are taken from the cost statement. The rates are taken from the cost statement. That's why that cost statement is very important. Pooja is coming with another sixer. Pooja says this is like a finance Sudoku we are playing. Wow. How many of you are still able to manage yourselves? Or some of you are feeling like drunk right now? Of course not. Not alcohol, but anything. Okay. So guys, everyone okay here? So materials, wages, expenses, all clear to all of you? So my working capital requirement, I want a confirmation that 2,26,000 minus 34 for single shift. I'm talking about 1,92,000. I hope everyone is comfortable to that extent. So we know if you kind of work around that fixed cost separately before you come to the working capital stage, that means then you are sorted. When Reddy said that he's able to manage, when he says he's digesting the concepts parallelly, very good. So guys, everyone okay till 1,92,000? And rest is history then. If you're okay with 1,92,000, I will tell you how the rest is your pretty straightforward. Let's move to the double shift now. Guys, I want a quick clarification from all of you. The rates we are taking here, you guys are all comfortable in these rates, yes or no? Because we had spent long enough time in these rates here. The statement of cost of double shift. 5.4 materials, wages becomes 4, overhead becomes 3, and so on. Everyone okay here? Rate wise, I think now at this stage, you should be just referring to the rate from the statement of cost, what we did in the previous slide. So my raw materials, because it's a double shift, 12,000 into 5.4, 64,800, because it's a 10% discount after all. We are talking about work in progress. Guys, work in progress was told as at prime cost, isn't it? Am I correct? So material plus labor, 5.4 plus 4, 9.4. This is material plus labor, prime cost given to us in the question. Finished goods at the entire cost, material plus labor plus overhead, it was 12.4. And so is debtors. And so is debtors. Mind you, the quantity is absolutely double except for our beautiful friend here, WIP. Prabhas is enjoying the Sudoku. So guys, every quantity is doubled except for WIP. And now you understand the double shift efficiencies, synergies. So my current assets are 3,44,000 here. Similarly, for the liabilities, my materials get doubled from 4,000 to 8,000. Wages and expenses doubled to 2,000 because it's a double shift. And the costs are coming from the cost sheet again, 5.4 for materials. Wages are both fixed and variable here. Similarly, expenses, fixed, overheads, fixed plus variable, 4 and 3. All these are taken from the statement of cost POS. Wages were reduced, per unit wages were reduced from 5 to 4 as Mr. Vinod said. Vinod, you agreed that, right? Because of that fixed and variable, it got a little complicated. So your wages was 5 per unit and now it's 4 because your fixed portion got reduced. And that's what we are doing right now. So my current liabilities are 57,200 and your working capital was 286,800. Trust me, by a layman, anyone would say, oh, We are talking about 192 as a working capital. Acha, we are talking about double shift. Let's do this. 192 into 2, 384. But are we correct in this? You can see the difference. It's not 384. It's 286. And this was a result of 3 savings. Your discount in terms of the raw materials and the savings of the fixed cost. Am I correct, guys? And I think probably also the WIP factor. You're not blocking the WIP double. That's also an important factor here. Hiral has a question, why we take creditors for wages and expenses? Hiral, because in the question, second last line, please read. Lag in payment of wages and expenses will continue to be 1 month, half month. Hiral, that's given in the question here. Is it okay, guys? Everyone okay? Doing good? I'm sure after solving this question, I'm asking you all okay. Probably it's too much, right? Asking for too much. I'm sure you need some time to digest this question. But I guess all is well that ends well. As I say that, I'm sure many doubts came in. I tried to resolve most of the queries. I'm sure the way you guys were getting bamboozled almost 15 minutes back, now probably you are feeling better, right? So, as I said, this question, if you go through a study material, there are 2 ways or 2 approaches. One was to solve the double shift as a policy implementation. And this is actually the requirement of the question. So I've done that way. But there is another way, if you want to just go through, where if we follow double shift only to meet the additional demand. If you're talking about only to meet the additional demand, probably we are just taking that as 2 different accounting, 2 different periods. Okay, that we need to have a 24,000 units and then another 24,000 units. Your ending WIP or your ending requirements become the beginning requirements for the next shift. But that becomes a little ad hoc in terms of the requirement of the questions. And that's why I've just covered this part here. So policy implementation, that is the call of the question here. Okay. Siddharth has an interesting point. Just a game of leverages. When there is a fixed cost, more sales, the profit will increase more than that rate. Absolutely wonderful, Siddharth. Hiral says, what's the weight? Hiral is like, probably properly talking about like a chartered accountant, right? Hiral is asking like, what is the weightage of this question as the exam? Let's come to the point. Of course, Hiral, I probably feel that, of course, if the question at that length will come, it would be for significant number of marks, or probably they could reduce a point or 2 in terms of the length. So it could be either ways, right? What you need to understand is a proper approach. How do we solve this? Right? How do we solve different like there are different aspects. We talk about the fixed versus variable. We talk about the WIP point. We talk about the efficiencies. We talk about the number of units and so on. Okay, guys, I think that's about it for today. We meet then on Thursday in continuation of our discussion. We will proceed to different parts of working capital modules. We talk about treasury management. We will also have a discussion. So what we are left over is we will be covering between Saturday and the coming Tuesday, the next 2 sessions with me. And I'm sure we guys will have a lot of fun together as we did today. I'm sure you guys enjoyed the session, tried to clarify most of the doubts. And in fact, I thank you everyone to be so proactive in my sessions where you guys don't hesitate to ask any doubt. And I think that's the best part, because you don't carry any burden home, right? Once the lecture gets over, you guys are straight off to the workload and just get to practice, apply those learnings, and that's it. So please don't forget, you need to do a lot of practice in terms of the working capital operating cycle number of days. You need to calculate, do the practice of working capital calculations. One of the questions I've already given you as a homework, as an assignment, and I'm sure you will do good. Okay, so thanks everyone. It